All right, let's do this. Welcome to the main event, the ultimate money fight of the century. In this corner, the flashy, high-flying superstar of growth, stocks. And in the other corner, the steady, reliable defender of wealth, bonds. Tonight, we are going to settle the score once and for all.
But first, you gotta listen up, because you need to stop making the #1 investing mistake that is literally costing you money right now. What is it? It's picking a side in this fight without even knowing the rules of the game. Well, that ends today.
Okay, let's get to know our contenders. In the world of investing, these two are the absolute heavyweights. But they are not just tickers on a screen, okay? Think of them as two completely different fighters. They've got their own unique moves, their own strengths, and, their own weaknesses.
Look, if you remember only one thing from this whole thing, make it this. It all boils down to one super simple difference. With stocks, you aren't owner. You're buying a piece of the action, a slice of the company. But with bonds, you are a lender. You're basically the bank loaning your money out. Owner versus lender. Get that? And you've got the whole game.
So, as an owner, a stockholder, your fate is completely tied to the company. If it crushes it, invents the next big thing, and its profits just explode, guess what? So does your investment. But if the company tanks, you're going right down with it. The upside is unlimited, but the risk is very, very real. Now, being the lender, the bondholder, that's a completely different story. You honestly don't care if the company becomes the next global superstar. You just want your regular payments. You get a fixed interest income, a predictable stream of cash. That's why we call it fixed income. You get paid, and at the end of the loan, you get your original cash back. It's that simple.
Ding, ding. All right, round one begins, the growth game. We are talking about pure, unadulterated wealth creation. Which one of these contenders can actually make you rich over time? Let's find out.
The history books do not lie, people. This is not my opinion. This is a cold, hard fact from Cambridge researchers. For over a century, stocks have just absolutely dominated bonds when it comes to long-term performance. It's not even a contest.
And just look at the explosive power behind that. In the years the stock market actually goes up, the average return is nearly 17%. That is not just some number on a screen. That is the kind of rocket fuel that builds real, generational wealth. That's your offense right there.
And that's it. It's a first-round knockout. In the long game, when it comes to pure growth, stocks are the undisputed, undefeated champion of the world. There's just no debate.
But hold on, the fight is not over yet. A good team needs more than just a star quarterback. So let's move to round two, the safety play. Because investing isn't always about scoring huge points. Sometimes the most important move is just not losing. So which of these assets is best at protecting your hard-earned cash? Okay, so the classic wisdom, what everyone tells their kids, is that bonds are your safe harbor, right? They don't swing wildly up and down like stocks. They're predictable, they're stable, they're the perfect defense for your portfolio. But here's the plot twist. In a world with crazy inflation and supply chain shocks and everything else going on, is that still true? Is your defense really as strong as you think it is? Just look at this data from JP Morgan. The volatility, the bounciness of U.S. government bonds has jumped 50% since COVID. So why? Well, when inflation runs hot, central banks raise interest rates to cool things down. And that makes your older bonds with their lower interest payments way less attractive. So their prices fall. All of a sudden, the safe play isn't looking so simple anymore. The whole game has changed. And this brings us to our final and most brutal round, the crash test. We've talked about growth, we've talked about stability, but what happens in the absolute worst-case scenario? The company you invested in goes completely belly up. Who gets their money back from the wreckage?
This all comes down to a super important concept called the liquidation waterfall. When a company goes bankrupt, whatever assets are left are paid out in a very, very specific order. Think of it like a sinking ship. Who gets the first spot on the lifeboat?
And here it is, the absolute pecking order. The big banks, they get paid first. But right after them, the bondholders. That's you, the lender. You have a legal claim to that money. And who's dead last? At the very bottom of the waterfall, often getting absolutely nothing? The stockholders, the owners. In a total collapse, being the lender is infinitely safer than being the owner.
So the fight is over. We've seen the strengths, we've seen the weaknesses. But what's the verdict? How do you build your own winning strategy from all this?
And the verdict is crystal clear. It is not stocks versus bonds. It's stocks and bonds. You need both on your team. Stocks are your offense. They're out there scoring those huge growth points. And bonds, they're your defense, providing that stability and getting paid first in a crisis. Okay, here's your playbook to build that winning team and keep more of your money. First, play in the right stadium. Use tax-advantaged accounts like 401ks and IRAs to let your money grow without the government taking a huge bite. Second, play the long game. Hold on to your investments for over a year to get much lower tax rates on your profits. And third, turn your losses into wins. It's called tax loss harvesting. This means you can sell an investment that's down and use that loss to cancel out the taxes you owe on your winners. It's a total pro move.
So we're left with this. The real question you need to be asking yourself isn't, should I pick stocks or bonds? The question is, what is the perfect mix of offense and defense for me? And that answer, well, it depends on your goals, your age, and how much risk you're willing to take. Now go out there and build your championship team.